Hey guys, warm welcome to you. Okay, so I want to do a quick video to talk about leverage, account size, and the type of Forex account you can open. If you're familiar with Forex accounts, if you go into a Forex broker, generally you're going to be offered a standard account, a mini account, or a micro account. Now, there are variations of this and there are different ways of doing it, but ultimately it depends on the lot size that you can trade. With a standard account, one lot is going to equal to about $10, or is $10 a point if you're looking at spread base. Every tick move is $10 positive or negative for one lot. If you've got a mini account, then that's 10,000 $10,000 position, which is equivalent of $1 per pip movement. So if it moves up 10 pips, you've got one mini lot and you're long, you make 10 bucks. If it's a standard lot, it moves up 10 pips and you're long $10 a point effectively, it's going to be $100 profit. You get the idea. And then the smallest account size is the micro account size, and that's 10 cents, so $0.1. Again, we're just dividing it by 10. So if it goes up 10 pips, you've made a buck. Doesn't sound like a lot, but you're allowed to open this with different trading account sizes. And the idea is that the leverage is adjusted to suit and different account sizes and account balances to accommodate each. Now, sometimes you're going to get higher spreads with some of these micros and minis compared to the standard. There's going to be different variations, but it's going to depend on the broker. If you're a spread better out there, if you're a CFD trader, spread betting, kind of the same thing. Just as we alluded to there, it's $10 a point, $1 a point, or $0.1 per point, 10 cents per point. Okay, so what I want to get to is this. The accepted leverage that top Forex traders, kind of institutional traders, I'm not talking about real big Goldman Sachs types, but guys who are trading, maybe an office of people, small fund, that kind of stuff. The accepted leverage they use is one lot per 50K of balance, one mini lot per 5K. That's what that is equivalent of. They're not going to trade obviously 5K batches and we're managing a lot more, but that's the general accepted inverted commas. Of course, we're going to have adjustments either way, but that is a sensible thing. If you were approaching an investor for money, you said, hey, I'm allocating one lot of size per 50 grand in my account, they're not going to suddenly say that's ridiculous, or they're not going to say, hey, you're not taking any risk. It's about right, give or take. And so we have this unusual scenario with retail Forex traders who come along with a couple of grand and say, hey, I want to open a standard account. Now, the minimum size you can trade on a standard account is one lot, one standard lot. So it's going to be $10. 200 pips a movement against you will wipe you out. Now, just think about that for a second. Think about the logic of that and how likely that is to happen. It's extremely likely. Going back to, we discussed your edge and how razor thin it can be and how you can have a string of losers at any one time. You can have a very, very profitable strategy, great risk reward, and still out of pure luck, you can have a string of losers. Tossing a coin, you have a string of tails, and that's a 50-50 shot. So imagine going in where all you've got to do, let's say you're risking 20 pips, 10 losing trades, and you're out of the game. That could be over 30 trades, you've made 20 losers, 10 winners, net 10, you're out of the game, assuming 1-to-1 and all that stuff. But the point is, what is the chances of success with that? So slim. So really what you should be doing is saying to yourself, hey, listen, if I have got a £100,000 account, $100,000 account, then I can open a standard account. If I've got 10 grand, then I can open a mini account. If I've got less than a grand, it's got to be a micro. That seems unfriendly, right? Because you want to make as much money as possible. But this will allow you to trade without killing you. Guys, leverage is the biggest killer of new traders, bar none. We can talk about the reasons why, we can talk about the discipline, we can talk about setup strategies, any of the stuff that adds to the pot, if you like, but it's all exaggerated and magnified by this one thing, leverage. They don't get enough time to learn the strategies, the discipline, all the things that we talk about on this channel all the time to improve, because they're not giving them the shot. After 10 trades, 50 trades, they're wiped out. They've wiped out all their money. They don't give themselves opportunity. If you went in and you had a grand account, you don't go and try and open a mini. You say, hey, I'll trade a micro. That gives you plenty of shots at having a go at it. It gives you plenty of chance to trade, to learn, to lose a buck, to lose 50 bucks, to not even, I mean, 50 bucks would be a lot in terms of pips, but to lose money and not have it affect you massively. You can train with that. You can afford to lose that. If you lose that over a year, you've paid $1,000 for a massive amount of training, and then you're ready, if you have got the capital, to go in with some bigger stuff. So just watching out, guys. Leverage is the killer. Many of you on the channel I recognize are seasoned traders, you're improving traders, but share this with someone who's just starting out. If you know anybody who's just starting out, give them a little tap on the back and say, hey, you know what, don't be tempted to go with the standard account just because it's a tighter spread or there's more benefits to that. The broker wants you to go with that. Go with the micro account, pay a bit more spread. If you've only got $1,000, go with that. If you've got less than 10,000, go with the mini. You know, just keep it low and low as possible. If in doubt, keep the leverage low. When you're ready to do it, you can dial up the leverage. It's always going to be there. Yes, there are things that have changed and adjust with the new rules that have come out, but forget about that for now. Risk management is what it's all about. Learning is what it's all about. And the majority of traders don't make it to where they want to be in trading or don't improve because they run out of capital. They trade, they're using too much leverage, they wipe out, maybe they top up again, they wipe out, they're done, they're gone, they're never to be seen again. So to ensure you don't do that, it's keeping the position size really, 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 really low in the beginning until you start to improve and till you recognize you've got some kind of edge. All right, guys, see you next one. Bye-bye.